morning, everyone. I'm Kevin Hincks. Welcome to the Daily Trader with Kevin Hincks. It's a Monday. We've got a massive week of earnings and economic data this week. And, some people ask me a question, how do you trade a week like this? And the key is, with 5 of the 7 Magnificent 7 names coming out with a lot of economic data, with a lot of secondary level stocks coming out, how do you trade a week like this? Well, the key is stay right with the things in front of you. Make the next trade. Don't look out to the end of the week yet. Those trades are coming on the horizon. Make the trades now that are right, that are timely. Make those trades, and then watch for the economic data coming, and watch for the macro trends and the micro trends, frankly, and stay in the trades that are around you right now. Today, we're going to look at the first 2 names coming up in the Mag 7. That is Google Alphabet and Microsoft. Google Alphabet is Tuesday after the bell. Microsoft is Wednesday after the bell. Now, there's a lot of other names coming up, as you know. In terms of our macro minute today, what you should be watching, it's an interesting day. Stocks are up about 0.5% in the S&P, about 0.7% in the NASDAQ. Crude oil is the big story of the day. Down almost, it's 5.5%. It was down over 6% earlier today. Think about that. On bombings in Iran, because they didn't hit the energy sites, crude oil is selling off on that. Why? Because the macroeconomic story on crude oil is bearish. The supply-demand story on crude oil is very bearish, but the geopolitical risks kept premium in crude oil. When that geopolitical risk starts to fade, this is what you see. Since Israel did not hit the energy sites, there's no disruption. You're seeing crude oil on the downside. That's not good for the energy stocks, but really good for any company that moves something from point A to point B. Cruise ships, airlines, rails, anything that might use crude as energy, it's good for. So, and it's great for the inflation story. So there's the macro minute. Now let's get to our 2 trades of the day, because I see some really interesting ideas here with some of these names. First, let's go to Google Alphabet. It comes out with earnings after the bell on Tuesday. This is a stock, interestingly enough, it's the cheapest valuation of the Magnificent 7 stocks, and it's first to go. So make sure you understand that. They're expecting earnings per share about $1.84 a share on revenues of $86.3 billion. That's 19% higher in earnings per share and 13% higher in terms of revenue. And here's the stat that should catches everyone's attention. In the last 9 quarters, they're averaging repurchasing their own stock between 15 and 16 billion shares. That's an average over the last 9 quarters. So 2 years and change, they've been buying between 15 and 16 billion shares of their own stock back. So that's their opinion of the valuation of their company. And like I said, it's the cheapest of the Magnificent 7 names. So what I looked, the lesson here for the Google Alphabet trade is vol dispersion. And what does that mean? That means the front event implied volatility at 73, almost 74%, is a full 21 points higher than the November 8th expiration, which is about 53%. So in this case, you're going to see a theme today. I'm going to point it out a little later in this little podcast here. It's we're selling the higher implied volatility, buying the lower here. So we're going to sell the front expiration, November 1st expiration, and we're going to buy the November 8th. And how are we going to do that? In the terms of a calendar spread, we're going to buy the 175 call. Remember, the expected move, about $9.50, which at 166, where it was 160, gets us right at that 175. If you think it might go further, then you choose another strike. If you think it could go down, you could do a put calendar as well. But the key here, the key edge that we're finding is in the dispersion between the implied volatilities. So when I look at that trade, buying the November 8th, selling the November 1st, lining up that expected move using the Thinkorswim platform, and doing the 175 call calendar. It's trading about 70 cents, right around there. 68, I look at, it's now about 72, so right around 70 cents is where this is trading. That seems to the eye as a pretty reasonable price for this calendar spread because you're selling a higher implied volatility than you're buying. Now, you still need things to happen. What you have at risk, whatever you trade, whatever the debit is on that trade, that's what that's the risk on this trade, and you're collecting theta each day. You've got a long delta of about three deltas, and you're looking for a move towards that 175 strike. You don't want to go too far. Remember, long calendar, buying the 73, selling the 73 implied volatility, buying about the 53 implied volatility in Google Alphabet. All right, let's get to our second trade of the day, and that is Microsoft. Microsoft coming out with earnings after the bell on Wednesday. They come out with earnings, and when you think of Microsoft, think of the ecosystem, think of all the different companies that they own, the massive amount of growth that's going on. Still expected, with the size of this company, still expecting double-digit earnings growth. So the fundamental strength of this company, by the way, that if you look at the last 3 months, it's only up 2%. It's actually sold off, off its highs of $468, currently trading about $430. So look, I see the 1 month, it's down about 1%. So 3 months, I have this, up 2.7. So this is a name that has come off its highs and is trading relatively reasonable. Remember, when you look at them, they're early. That's what sticks out in my head when I think of Microsoft. They were early into ChatGPT and AI when they invested $10 billion in OpenAI and ChatGPT. They're early in terms of energy, getting involved with Constellation and 3 Mile Island because they know they're going to need energy and lots of it. So the great quality of Microsoft is they are early into everything. They are ahead of the curve as we look. I mean, the stock is, like I said, relatively inexpensive historically when you look at the overall numbers, but it's a stock that is in 3 of the 4 major indices. So if there's a global sell-off, make no mistake, Microsoft will sell out. Look at the dates on your chart between about the first week in July and the first week in August. Pretty harsh month for Microsoft there when the overall market sells off, being in 3 of the 4 major indices, the Dow, the S&P, and the NASDAQ. This stock's going to sell off too. So there's the risk, is the global sell-off. So now when you look at that, they're in cloud with Azure. They've got Skype, they've got LinkedIn, Xbox and Activision, they've got GitHub, so many, too many to learn anything having to do with Microsoft Office and 365 this company's involved in. So how do we look at Microsoft? Well, like I said, this stock is down off its recent highs, hit its high right around the first week in July. Looks like it traded in almost $470. What I looked at here, elevated implied volatility in the front expiration gives us an opportunity to look at the expected move, about $16. Look where the stock's trading, about 429.5. And what we did here, looked at the short put vertical. So I lined up the expected move, sold the $410 put, bought the 400 put. So a $10 short put vertical. Now, the risk on this is much bigger than the credit taken in, but that's always going to be the case in short verticals. But if you look at the probability of finishing out of the money for the 410 put, about a 78% chance that $410 put will finish out of the money. That's what we call a high probability short put vertical. It's high probability, it's risk defined, and it's collecting theta, 3 of the pillars of trading high probability spreads. So going back to our trade, it gives you about 9 long deltas. It does have risk. Remember, the risk is the width of the strikes, in this case $10, minus the 165 credit that you took in. So it is the risk reward favors the risk side, right? It's much bigger risk than reward, but it's a very high probability short put vertical. right? The margin on this trade is the width of the spread, so about $1,000. And the risk is, like I said, the difference between $10, the width of the strikes, and $165, so about $8.35 is the risk on this trade. All you can make is the credit that you take in, but it's again, the similarities between these two spreads, if you notice, we're selling the event expiration, taking the high implied volatility and selling that. In the first case, we're buying the second week. In this case, we're just selling a short put vertical in the first week. So we're selling high implied volatility. 2 trades on 2 of the Magnificent 7 names. This is Kevin Hincks for today's Daily Trader. Have a great day, everybody.